Hi, good morning, everyone. I'm just going to give us a couple of seconds to let everyone in. Welcome, good morning. Hope everyone's doing well. If you want to drop in the chat box where you're calling in from or listening from this morning, we'd love to have you say hello and see where you're coming from and where you're representing. I'll wait just another couple of seconds. Hi, good morning, Sarah from Buffalo. All right. Well, I'm going to go ahead and get started, make sure we're good stewards of your time and our time as well. Welcome and good morning. Again, my name is Julie Brannon. I am the Membership Manager and DEI Specialist here at Nikon. I will be helping and facilitate and run some background things here on the webinar today. Just to make sure you're in the right place at the right time, this is understanding how nonprofits can best use employer and health insurance tax credits. We'll be covering both of those here. This is a joint presentation by Nikon and also the New York State of Health. A couple of quick housekeeping items before we get started. If you check out here now in the chat box, I'm actually going to drop the disclaimer in there as well, but we are recording this webinar. We will send out a link to the webinar as well as a copy of the slides probably later this afternoon, so you will get a copy and a link to both. We do have everyone automatically muted and there's no webcam, so other than the presenters, you won't be able to see anyone else or share your webcam as well. So speaking of that, if you have any questions, we do encourage you to use the Q&A box, which is on your Zoom webinar panel. So any questions, drop those in the Q&A box. Feel free to chat amongst yourselves in the chat box, but we would prefer to use the Q&A box for questions, so please send those there. If you have any technical difficulties along the way, feel free to reach out to me directly. You've got my email address with the email confirmation that you received earlier, so you should have that. I'll also drop that in the chat box as well, just in case, and I'm happy to try and help you troubleshoot some of those issues if you're having any. So without further ado, I am going to pass it over to Michael Greklek from New York State of Health. He is going to cover the American Rescue Plan Act and talk a little bit more about that before we go into the second part of the presentation with Andrew Marietta from Nikon. So, Michael, I will pass it over to you.
All right, thank you very much. Just give me a second while I share my screen. Okay. All right, can you all see my screen? Andrew? Yep.
Yep, looks good.
Okay. All right. All right, thanks again. My name is Michael Greklek. I am from the New York State of Health. Today, we thought it would be a good idea in speaking with Nikon, specifically Andrew, to review the American Rescue Plan, as well as the COBRA premium subsidy that affects employers. So that's kind of the reasoning today. I am the director of the New York State of Health Private Pay Home Care Program. I started 5 years ago in the SHOP program, which is the Small Business Health Options program. And also I help manage the broker program for New York State of Health. So I've been involved in all aspects of the exchange, which has been fun, enlightening, and engaging. I appreciate all of you coming today. Today's agenda is, again, we're going to overview the American Rescue Plan, including the eligibility factors, and review some of the advanced premium tax credits. We'll also refer to that as APTC. Really what that is the subsidies that individuals receive to help cover all or some of the premium for a qualified health plan, which in general is just individual health insurance through the New York State of Health. We're also going to review, as part of ARP, there's coverage available, or subsidized coverage available for unemployed New Yorkers. And then also we're going to review that COBRA continuation of coverage. First, let's take a look at the American Rescue Plan Act. It was signed into law on March 11th, 2021. There were three main goals within the American Rescue Plan. One is to mount a national vaccine program and contain the COVID-19 and safely reopen schools. The other items are deliver immediate relief to working families bearing the brunt of this crisis. We are going to concentrate on the items that are highlighted in yellow, which is the increasing of financial assistance for health insurance premiums, and then of course the coverage for unemployed New Yorkers. But you can see here all of the different things that the ARP was, signed into law and was, able to, at least address some of the different goals that were affecting consumers and all individuals that have been affected by COVID-19. All right, so here, as already mentioned, the American Rescue Plan increased financial assistance for the health insurance premiums. Essentially, it's going to lower or has lowered health insurance costs by providing new and expanded financial assistance, which are the subsidies, also known as the APTC, to New Yorkers who are enrolling in individual health insurance coverage, also known as a qualified health plan, through the New York State of Health. This enhanced assistance is available to current enrollees and new enrollees, including, for the first time, higher income individuals who are over 400% of the federal poverty limit for the first time. All right, which is pretty important. So not only did ARP increase the subsidies for those individuals that are below 400% of the federal poverty limit, it's actually providing assistance for those over 400%, which is significant and one of the reasons why we wanted to get out here and make sure everybody was aware of it. The American Rescue Plan, as you can see here on this slide, the American Rescue Plan will provide coverage for unemployed New Yorkers as well by increasing the subsidy for people who received unemployment insurance in 2021, which is more good news about healthcare for New Yorkers who are eligible for unemployment insurance in 2021. If a consumer has been eligible for unemployment insurance for at least 1 week in 2021, the American Rescue Plan states that they will be able to sign up for a $1 plan through New York State Health for coverage that lasts for all of 2021. To be eligible for this plan, they cannot be eligible for other health insurance, such as Medicaid, Medicare, Child Health Plus, the state's essential plan, or affordable employer-sponsored coverage. So if you have an individual that is being offered and enrolled in affordable employer-sponsored coverage, they are not going to be eligible for that unemployment benefit, which makes sense, I think, right? Okay, flip back. All right, so on this slide, we're going to review the APTC eligibility. Consumers who are eligible for Medicaid, Child Health Plus, and the Essential Plan are not eligible for a subsidy. Consumers who are offered employer-sponsored health insurance, as I just mentioned, that is considered affordable, are not eligible for tax credits. So in order to receive a subsidy, consumers must attest that they will file their taxes. If married, they will file it jointly, with some exceptions. This is so the IRS can reconcile the subsidy that's being received on actual income. So all this is handled when they file their taxes. All right. So it started in early April. Individuals with low and moderate incomes became eligible for higher tax credits. All consumers that were eligible for the subsidy were redetermined in our system and became eligible for more tax credits. And of course, we sent notices, emails to these consumers to let them know about the higher APTC amounts. And then of course, if any action was necessary on their part to either accept those higher APTC amounts, or maybe we needed some additional information from them. And then also, as we mentioned, starting this month, a couple of weeks ago, for the first time, expanded tax credits to tens of thousands of additional New Yorkers were with higher incomes who before the American Rescue Plan did not qualify for financial assistance. For those individuals, APTC is now available for those individuals and families over 400% of the federal poverty limit. Here on this slide, you can see that people with incomes over 400% FPL, which means their income is over 51,040, will be expected to pay 8.5% of their income towards health insurance premium. So their expected premium contribution can be found by calculating at 8.5% of their income, or what their income actually is, and then subtracting that amount from the price of the second lowest cost silver plan available to them in their county. There are two examples on here on the bottom right-hand side where plan prices are a bit higher than surrounding areas, and due to this, consumers in these counties will get a nice boost in their APTC. So if you take a look, an individual in Kings County earning $55,000 per year, which is approximately 430% of the federal poverty limit, would receive over $230 a month or $2,800 a year in subsidized coverage. And then you have an individual with income of $64,000 per year, which is around 501% of the federal poverty limit in Nassau County. They'll now qualify for $144 a month in subsidized coverage, which is pretty significant. So to recap, under the American Rescue Plan, the subsidy eligibility has been expanded and premium contribution have been reduced. So prior to the law, individuals may be required to contribute up to 9.83% of household income. Now anyone over 400% of FPL will have a maximum income contribution of 8.5%. And tax credits are available to higher income families for the first time, as mentioned. So the 8.5% of income is the cap for both 2021 and 2022, which is pretty significant. For those, since the ARP was passed in March, and then us as an exchange did not get it implemented until April, and then as well as June, for any of those individuals that were eligible for the expanded APTC, whether or not you're under 400% of the FPL or over 400% of the FPL, can claim retroactive subsidies back to January 2021 when they file their taxes for the 2021 tax year. So in order to be eligible for the retroactive subsidy reimbursement, you must have been enrolled in a qualified health plan, of course, through New York State of Health since January. So in order to be eligible for a subsidy, you have to be enrolled through New York State of Health. That's just how it is. All right, so the coverage for unemployed New Yorkers. The American Rescue Plan does provide coverage for unemployed New Yorkers. Regular unemployment benefits were extended, and so were pandemic unemployment benefits. Many of the pandemic unemployment benefits were put into place by the CARES Act and the Families First Coronavirus Relief Act. The American Rescue Plan keeps these benefits going through August 29th of 2021. New York State of Health, as New York State of Health, we've already enhanced functionality to implement the new rules to allow our consumers who have been eligible for unemployment insurance for at least 1 week in 2021, a $1 health plan through us here at New York State of Health, and the coverage will last through the end of 2021. So we have identified and contacted individuals that were in our system who qualify for this benefit, and we'll continue this process several times a month through the end of the year. And just as a reminder, to be eligible for this plan, the consumer cannot be eligible for other health insurance, such as Medicaid, Medicare, Child Health Plus, and the Essential Plan, and of course, affordable employer-sponsored coverage. So one thing that I wanted to mention is that, so for an individual that was not in our system, we would not know about them. So if you have a worker or someone that has been enrolled or eligible for unemployment insurance benefit, unemployment benefits for at least a month in 2021, they can come into our system and apply for coverage, assuming that they're not already eligible for Medicaid, Medicare, Child Health Plus, and Essential Plan, and are being offered employer-sponsored coverage, affordable employer-sponsored coverage. They can come in and see what they're eligible for through us. So that's something to be aware of. All right, so we're going to move on to the COBRA provision of the American Rescue Plan Act. And this entails a subsidy that's available to individuals via an employer tax credit. So for COBRA continuation of coverage, it gives the ability to for the individual to continue group health coverage under a former employer's plan. This includes both the dental and vision plans, but does not include disability and life insurance. And a really important item to note is that this provision only applies to employers with 20 or more employees. What we've done here, and you'll see also further in this presentation, is we've provided a bunch of resource pages so that you can peruse this information yourself. They did a really good job of communicating this benefit, as well as all the benefits under the American Rescue Plan Act, providing FAQs and different resources for employers and others to just kind of get a handle on it as well. So right here, you'll see the source for this information, and you'll have access to this after. I have no problem sending the slides out. One thing we also want to know, of course, the disclaimer: the New York State of Health, we do not offer consultative tax advice or tax advice, and we refer you to the IRS and DOL for additional information. And I have more specific links later on in the presentation. So to be eligible for the premium assistance, the individual needs to be, the American Rescue Plan and the premium assistance. So what's being covered? Essentially, a COBRA eligible individual will pay 0% of the COBRA premium between April 1st and September 30th, 2021. So essentially, their premium would be covered at 100%. Premiums are reimbursed to an employer or the plan or insurer via payroll tax credit. And of course, because these individuals are eligible for this provision, there had to be a second election period called the extended election period to allow them to enroll in this plan if they weren't already enrolled in coverage through their former employer. So generally, an individual is eligible for this COBRA subsidy if they're a qualified beneficiary as a result of involuntary termination of employment. As with most things, it does not include if the individual was terminated for gross misconduct. Also eligible due to a reduction in hours, losing eligibility to health insurance due to a reduction in hours is a staple, so that should not be a surprise. Also eligible for COBRA continuation coverage at any time during the assistance period. So if they're eligible for COBRA coverage during that period, then they're eligible for the subsidy. And of course, they have to elect coverage in order to be eligible for the subsidy. They have to be enrolled. The subsidy itself is available beginning on or after April 1st and then ends on September 30th, 2021, or at the end of the qualified beneficiary's maximum COBRA continuation period. So if their continuation period or they're no longer eligible for COBRA lands in the middle, then they're no longer eligible as of that date for the premium assistance, because again, they wouldn't be eligible and they wouldn't be enrolled. Or the first date eligible for another group health plan or Medicare. So this is if an individual no longer works for you, they were terminated due to various reasons other than misconduct, and they obtain other employment in which they're eligible for coverage, employer-sponsored coverage, they would not be eligible for the subsidy. There is a notification requirement. The qualified beneficiary, so the individual COBRA participant or the person that's eligible for COBRA coverage, is required to notify you as the plan or COBRA administrator or whatever you have in place of eligibility for other group health plan coverage or Medicare. So the onus is on the individual to make sure that they let their former employer or the administrator that's administrating the COBRA policy for their former employer that they have access to other coverage so that the subsidy is no longer available to them. Employers are allowed to request self-certification or attestation of the eligibility status. You can require the individuals to self-certify and attest that they are eligible for the COBRA premium assistance or other group health plan coverage or Medicare, which protects you as an employer. I always suggest doing this type of arrangement to protect yourself and keep it on file. So I'll get back into some resources available right after I think this and another slide that will provide you as employers resources that can help you kind of make sense and read a little bit more on the subsidy, the COBRA continuation of coverage subsidy that's available, because there are some other things, notification requirements and all that. And again, mainly the main point, and I'm not aware of all the different levels of employers that are on this call, but it affects those with 20 or more employees. One thing we're doing here at the New York State of Health is that we have an extended open enrollment period through the end of 2021. This gives everyone the opportunity to apply for the first time or update their application or change plans. We do know that applying or updating their application will likely result in more tax credits due to the American Rescue Plan. And this applies to both those that were currently enrolled as well as newly eligible. And then the ongoing open enrollment period extension will allow as many consumers as possible to access these enhanced tax credits while taking into consideration the ongoing public health emergency. So this was important for us to extend it through 2021. And this correlates to the COBRA continuation of coverage. Although if they lost COBRA coverage, they would then be eligible. They lost employer-sponsored coverage, they'd be eligible to come to the exchange to see what they're eligible for. But this will be a seamless transition for those that might terminate their coverage through their COBRA coverage through their former employer as of September 30th, when the premium assistance is no longer available. They could then come to the New York State of Health and apply for coverages and obtain that as of November 1st. So here are the resources again. We usually print out the actual URL, which looks like a lot, but when you receive a copy of the presentation, you'll be able to click on it as well from the slide. Here at New York State of Health, we created a bunch of different fact sheets. So one is a financial assistance fact sheet for those consumers that, just a high overview of the information of how you're eligible based on certain income requirements and what's available to you through the American Rescue Plan. We've also created a fact sheet for those New Yorkers who are unemployed. And then the bottom bullet is access to the New York State of Health website, where you can go in and use what we call anonymous shopping tool, and you can shop and see what coverage is available, as well as get an estimate of what you are eligible for from a subsidy standpoint. So that's important to know about. And then we also created, just in general, FAQs for frequently asked questions, if you're not aware of that acronym, of the American Rescue Plan and how it integrates with New York State of Health. And then we also provided the link to the IRS FAQs regarding the COBRA continuation of coverage under ARP. And then the DOL website, which actually was really well made and well put together in relation to explaining the COBRA premium subsidy and how it pertains to employers. And it's everything you need to know. So I highly recommend, if you have any questions, again, if you're an employer with over 20 employees, or you're just interested in general, to take a look at that particular link. And thank you for having me. I really appreciate the time, and I will be taking questions at the end. I'll take a look through the Q&A feature and see what I can answer. And now I'm going to hand it over to Andrew.
And Michael, I just wondered, there were, just two quick questions I thought that would be great just to answer quickly. One was a question I'm sure you get all the time, and it's how is affordable healthcare defined? And I know you may not be able to get into the real specifics, but can you just give a quick, some quick feedback on that question of how affordable healthcare is defined?
Yeah, and again, I'll just preface that I can't provide consultative advice. That might go in your area. But essentially, there is a COBRA, an employer safe harbor rule. All right. So if that individual is enrolled in affordable health coverage through their employer, they're not eligible for subsidy. That's typically defined as 9.83% or 9.86% for 2021. So that individual cannot contribute more than 9.86% towards the lowest cost individual plan that the employer offers. So if you're an employer and you offer three different types of plans, one is a very high deductible, maybe max out, then you offer a copay plan, you have to consider that based on the individual lowest cost plan, which will most likely be that high deductible health plan. And what I am unsure of is if that safe harbor was updated to reflect the 8.5%. So that's something that we'll have to get back to you on, but it was 9.86% prior to the ARP changes.
And then Michael, there was one other question which I know comes up all the time, in regards to, where an employer offers a health insurance option but doesn't make any contributions on the employer side, and so so the scenario somebody was just asking is that they have access technically to health insurance through, I think, a spouse's employer or some kind of scenario like that, but there is no contribution. The like the monthly premium would be the full cost, say $700 or something like that. It going back to your definition of affordable health care, they and those kind of base percentage contribution amounts, if the employer isn't contributing anything but technically offering a health insurance plan, it would allow somebody to go to the exchange, obviously, right?
Yeah, it's going to depend on that family dynamic, married, single, what the spouse has access to for coverage through their employer, total overall income, not just through you as an employer, but any other employment that individual has. So in that regard, if you're a small group employer, you're not eligible, you're not over the 50 mark and not um, going to be responsible for that employer shared responsibility, tax penalty, that individual could be eligible for Medicaid, essential plan, or a subsidy through the exchange. Um, I kind of advise that each individual situation, and I know with smaller employers you typically know that individual way more than a larger employer, is to just get them to the exchange to see what they're
Right.
eligible for. The application asks all the questions that are needed to see if they're eligible for. So really rely on the application process.
Yeah, I was going to say that the system itself, the New York State of Health kind of online system, when an individual goes there, and obviously the first step is setting up their username and password, their profile, and then if they really, it comes down to, I mean, I in my own experience of helping individuals look at the exchange as an option, you absolutely, that is probably the soundest advice. I totally get that. You really have to go there as an individual and look at your own circumstances, because you are prompted to input all the information, who your employer is, how much the contribution, or what your wages are, and then if you do have access to health insurance, what the employer contribution is or no contribution, and that the system absolutely does do the basically that verification process, and then makes the determination. So that really is the only way, I suppose, that people can really have their answers, get the answers to those kinds of questions.
Mm-hmm. Yeah, exactly. Very well put.
So yeah, and we're gonna just transition here over to the other part of the presentation, and I think overall, the whole idea here that we were trying to explore is these opportunities that organizations as employers have available to them, especially tied to the American Rescue Plan Act. These ways of maximizing the resources your organizations have, especially as employers, and the exchange is a great resource. I mean, we through Nikon, and especially through our subsidiary insurance brokerage, Counsel Services Plus, we work with many nonprofits around employee benefits, and the exchange has always been an important resource and option for employees. Of course, depending on their circumstances, especially if the employer doesn't offer an employer-sponsored health insurance plan, or an employee is in between jobs, and they have a qualifying event and they need coverage before they're able to secure coverage with another employee through a new job, and we see that happen frequently. And of course, there's as Michael had highlighted, all these enhanced benefits, especially with the large number of people who unfortunately find themselves in circumstances such as being unemployed right now. So the exchange is an invaluable resource, and these credit enhancements are a great possible resource for organizations to be aware of, or especially when you're dealing with some of the consumers in terms of direct service delivery that many of our nonprofit partners are carrying out. So we also wanted to kind of bring into the discussion another tax credit, the employer retention tax credit, which is another opportunity for organizations to look at. And it is a very hot topic right now, and I think something that many organizations are exploring and trying to figure out how best to take advantage of it. So I'm just going to do just a general overview to try to give folks some context around the employee retention tax credit, and and then I think as the year progresses, we'll be continuing to talk about this topic, and it's something that I think many organizations are giving more consideration to, and so in a way we're at the beginning stages. I mean, we did just finish, so we're wrapping up the second quarter, and as I talk about the retention tax credit, that's a lot of your determination is quarter by quarter. So you already have first quarter done. Now we're looking at looking back. So you have January, February, March. Now we have April, May, June. We're wrapping up June here today. And so that's when we're going to be making these determinations about the applicability of the employee retention tax credit, which is a refundable payroll tax credit that is taken against your employment taxes that you're paying. And we'll talk about kind of those employment taxes and basically what you're getting back, that refund. And so, the whole idea here is to keep employees employed and on payroll, just like the PPP, the Payment Protection Program. And so, you actually have now an opportunity to take advantage of both of these. And I'll again talk about that in more detail here. But just like Michael had, briefly discussed in terms of the American Rescue Plan Act, the ERTC has had kind of some evolution in terms of initially being introduced under the CARES Act back in March of 2020, and it was available to the end of 2020. Originally, what you actually couldn't claim the credit if you received a PPP loan in 2020, and then that was actually then reversed, and with the Taxpayer Certainty and Disaster Relief Act at the end of 2020, so which extended this tax credit into 2021. Also lowered the threshold for the gross receipts decline, and increased the credit, actually increased the number of employees, and again reversed this issue of not being able to take advantage of the ERTC if you did receive a PPP. So we'll talk a little more in detail the difference between 2020 versus 2021. But there is it's a higher gross receipts decline for 2020, 50% versus 20% for 2021, and the credit is definitely much lower in 2020 versus 2021. So we'll look at some of those distinctions. But then in terms of the American Rescue Plan Act, that then extended the ERTC for all of 2021. So now organizations have an opportunity to actually claim this credit for each quarter in 2021, depending again if you are eligible and qualify. So and we'll look at some quick scenarios of that eligibility. But basically this idea, the 2020 versus 2021, the credit period for 2020 is March 12th to January, essentially the end of 2021, January 1st, 2021. And so the eligibility is either that your organization had a full or partial suspension through a COVID-19 governmental order, or there was a gross receipts decline of 50% compared to your gross receipts in the same quarter of 2019. So we'll look at that more in a little more detail here. And then 2021, the distinction is that, again, it goes for the entire year of 2021, those 4 quarters. And the same similar eligibility in terms of a full partial suspension by a COVID-19 governmental order. And we'll talk a little more about that governmental order kind of suspension. But the gross receipts decline qualification in 2021 now is a much lower threshold. So it's 20%. And so you're comparing, again, first quarter 2021 to first quarter 2019 to make that comparison of what your gross receipts decline is, and then to see if you're eligible for the tax credit. And I just included just a brief definition here on governmental order, just for your reference. And it kind of leads into the next slide here about this business operation suspension, which is one of the ways you can qualify for the employee retention tax credit. I think, there's a little more detail to this, and, it's not, I guess the main takeaway from my perspective is it's not as simple as just saying, yes, we had a partial, a full or partial operation suspension in terms of our organization. There, as you'll see, the language in the, related to the employee retention tax credit starts kind of getting into this if it had to be more than a nominal portion of its business operations as impacted as a result of that governmental order in terms of the suspension. So that, that definition of more than nominal portion gets into groceries. This first bullet point here, gross receipts from that portion of the business is not less than 10% of total gross receipts. So you're actually looking at the actual impact to your gross receipts. And so I think one of the takeaways is really, would be ideal, depending on your organization and the access you have in terms of expertise, but it would be ideal to consult with your CPA firm, for example, that if you are subject to a qualified financial review or a full audit, that CPA firm would be ideal to help you kind of look at this as an option if you're pursuing the business operations suspension in order to qualify. And the main reason you would be looking at this is that you wouldn't qualify under the gross receipts reduction, threshold for 50% for 2020 and 20% for 2021. But I will say that this is definitely an option for organizations to look at. It just requires more due diligence and and really making sure you have your documentation in order to claim this the impact, this operation suspension from a governmental order, so you can define this more than a nominal effect. I kind of look at this as just because it would require a little bit more work. I look at this more as maybe a second option versus gross receipts decline, which is, I think, more straightforward, easier to kind of grasp. So in terms of 2020, again, because there is a distinction between how you look at qualifying versus the 2 years. First of all, you're looking at this quarter comparison. So first quarter 2019 versus first quarter 2020, and you're looking at that drop in gross receipts to try to calculate the percentage and then to see if you qualify for the tax credit. So obviously, if we're looking first quarter 2020, for most organizations, they really weren't impacted by the pandemic significantly because March is really when it hit. So really, second quarter is where most organizations are seeing that dramatic drop. So in this scenario that I outlined here, you can see in second quarter, April to June, for this organization, hypothetical organization, you see their difference between their 2019 gross receipts as compared to 2020 gross receipts is 40%. So in terms of that qualification, they do qualify for the employee retention tax credit because they have that decline is greater than you know, it meets that 50% threshold. So as you look at kind of how this works, you'll see then the second piece to it is that, you know, once they qualify, there's this look back provision. So it's not that they just get second quarter, they actually get third quarter as well in terms of qualifying for the employee retention tax credit because of the look back provision that's in place. So although they are no longer qualified as of the third quarter, because their gross receipts are greater than 80%, so they technically are now disqualified moving forward. So they qualify in second quarter, they get the third quarter because of look back provision, and then the fourth quarter, they no longer have access to the credit because they essentially are disqualified if you are looking, you know, at that 86%. So, you know, so hopefully that makes sense. So you have that second and third quarter now to actually claim the credit, and we'll talk about PPP versus the wage treatment and how this interacts, you know, with employee retention tax credit versus PPP here in a moment. So same kind of scenario if we follow this through with 2021. Now it's, you know, it's less than 80%, so that, you know, we're looking for that difference of 20% in terms of the decline in gross receipts as our threshold. So we're comparing first quarter of 2019 to first quarter of 2021. And so as you can see here, in this scenario, first quarter they qualify, second quarter they qualify, and then the third quarter is where they are above, you know, they're greater than 80%. And so they now are no longer qualified, but because of the look back provision for second quarter into third quarter qualifies. So now they have first, second, third quarters all qualify for taking the employee retention tax credit. And so we don't know what fourth quarter looks like yet. And so, you know, just hypothetically looking at this, so if their percentage ends up being at that 20% threshold, so if it comes in at say 79% or 80% in the fourth quarter, they then will requalify. And so they will now be able to claim the entire year, all 4 quarters for employee retention tax credit. So, you know, so this is, I think some organizations don't realize once they qualify in the first quarter, if they then have that, you know, that their gross receipts comparison is greater than 80% in that second quarter, they still actually get to claim the second quarter because they qualified in the first, and and that look back provision applies. So that's a good, you know, just piece of information just to be aware of and to the advantage of your organization. So there's a couple questions that have come up that, you know, I thought would be good to just address and clarify. One is that this issue of gross receipts and PPP, organizations have been asking, you know, that as you're looking at the employee retention tax credit by quarter and you have your PPP and suddenly the PPP loan forgiveness comes into play, won't that impact that quarter in terms of PPP's treatment as revenue? Because you're recognizing it now as you know, you've secured loan forgiveness, so you no longer have it as a liability, and so now it's recognized as revenue on your financial statements. And so wouldn't that be counted as gross receipts? And actually the answer is no. We know from the employee retention tax credit FAQs that define gross receipts that for a nonprofit, it's the Treasury 60/30 regulations, and that those actual regulations don't interpret PPP as revenue. So it's excluded. That PPP loan forgiveness funds are actually not treated as revenues from the standpoint of gross receipts, and so you don't have it doesn't impact your gross receipts reduction calculations. So that PPP has no impact. So it's, you know, and it's also not taxable. We also know that from IRS guidance, and that's not an issue for the nonprofit sector, but that of course is an issue, you know, something of benefit to for-profit organizations. So that PPP money is not counted as income. And then another question that's come up every once in a while is the eligibility side of it, full-time versus part-time. A question has come up, well, we can only claim the ERTC for full-time employees. The point of confusion here is that there are some factors here around eligibility where full-time employees come into play, but it's only around the employment numbers. So when you are looking at how you qualify for ERTC, in 2020, it's 100 employees and less. In 2021, it's 500 employees and less. And it's not an FTE count. It's actually the average of 30 hours worked per week or 130 hours per month that you're using to figure out that average full-time employee number. And so once you figure out that number, that's where you're qualifying for the ERTC. Then when you're looking at wages, as well as some qualifying health insurance costs that you can include as a part of ERTC in terms of claiming, you're looking at actually what's paid to all employees, including part-time employees and of course full-time employees. So, but the other factor here is the use of PPP funds in 2020 and 2021 that we'll talk about in a moment. So then I just have a couple charts here that just give a little bit more context. Again, for reference, just as we look at 2020, 50% is the actual credit. So it's 50% of the qualified wages paid to the employee, and that credit is capped at $5,000 maximum. So it's $5,000 per employee annually. So it's very different than the 2021 credit, where it's 70% of those qualified wages. So 70% of the first 10,000 versus 2020, 5,000 or 50% of the first 10,000. So that's where these calculations are coming from. But for 2021, we actually can claim that $7,000 per employee per quarter for a maximum of 28,000 for the entire year. So, and 28,000 not being the, that you could, and I just touch on this in a slide later, but 28,000 being if you were able to claim the maximum credit each quarter, all 4 quarters for 2021. You can't, there's no carryover provisions or anything like that. The only way you're going to get the full 28,000 is to be able to fully claim 7,000 each quarter per employee, which for any organization that got PPP, that probably is unlikely. So, we'll talk about why that is here in a moment. And again, that credit eligibility side, again, in 2020, it's a threshold of that 100 employees, that average employee number that comes from looking at that 30 hours per week. And this includes, employees that are working and not necessarily working. And so as you looked at 2021, that threshold increases to 500 employees. Now, it also includes that as well as same provisions as 2020. So employees who may not be providing services, and of course, who are providing services. So now you can claim, those applicable wages. And then in terms of the actual payment of the credit, there is an option where you could receive advance payments. I would say the majority of organizations are not pursuing this option, and we've through our own board members that have a lot of experience and expertise in this area of filing for the ERTC. They've worked with a number of their clients to try to file for the advance payments, and from what I understand, no one has received the advance payments from the IRS. So there is no real advantage to trying to file for the advance payments. So where they're basically filing to reduce their tax deposits and in anticipation of getting that credit, but you still have to wait for the IRS to make that determination and then allow you to do it. And the IRS is, in terms of processing, for a variety of reasons, it's very, very slow. So there's at this point, no real advantage in doing the advance payment option. You'd also have to kind of have your calculations in order and really understand kind of where, if you're eligible and kind of know the numbers behind your potential employee retention tax credit. There there's this factor around limitation on increase in pay rate. So there in 2020, they had a 30-day look back period for determining the wages that counted towards the credit. But then in 2021, they repealed that look back period. So they allowed raises, bonuses to now be counted as a part of the credit. So that's one distinction versus 2020 versus 2021. And then also the PPP loan eligibility that I mentioned earlier. In 2020, you could actually not claim the credit if you received a PPP. That was then repealed in 2021. So you could go back and claim the credit in 2020 as well as 2021. And just in terms of claiming the credit, again, you could definitely, it would be to your advantage to talk to your CPA firm or qualified, if you have a bookkeeper, whoever might be offering some of your assistance around filing your payroll filings with the IRS. There'd be an advantage to talking to them about how you can file and claim for this refund. But in 2020, you actually are going to make, you're going to file for this refund by making an adjustment to your actually previously filed payroll. So you're going to go back and file the Form 941X, and that's going to help you, revise your quarterly federal tax return to make the claim for this refund that you've already filed. Obviously, you've already filed your quarterly filings with the federal government for 2020. So we're going back and we're revising it, amending that. And again, if you receive a PPP loan, and in many cases, most employers did not look at the 2020 employee retention tax credit because you were barred from doing so. Now, organizations are going back and looking at 2020. The challenge with 2020 is more the use of PPP money, and I'll talk about that, and the smaller credit. So I would say for most employers, they really are focusing on 2021. And so this is where, as you're filing those quarterly payroll filings with the IRS, this is where you're going to file and claim this tax credit. So you're reporting those total qualified wages with the focus on the ERTC, and then claiming the credit on your federal employment tax returns. And so that's going to be your quarterly Form 941. So that quarterly payroll filing that you are doing, from New York State, you're filing the NOS 45. For the IRS, you're filing the Form 941. So that employer quarterly federal tax return is where you're going to claim the ERTC. And so originally, up until June 30th of 2021, it was being claimed against your share, your employer share of the Social Security tax. After July 1st, it's now going to be on the employer share of the Medicare tax. It really, probably from your standpoint, that doesn't matter at all. You're essentially, you're filing, you either get to roll this over so that the credit is going to pay those future portions of those taxes, or it is possible to actually get a refund, where you'd actually get funding back to your organization. But in general, I think most organizations are going to not be filing for this advance payment, which is my last point here. I think most are kind of, they're going to finish the quarter, they're going to see if they qualify, and then as they are filing that Form 941, they're going to claim the employee retention tax credit as a part of the quarterly Form 941 filing. And then the last pieces here I just want to touch on before we jump into the questions here is this interaction with ERTC and PPP. So you, again, as an organization that received a PPP, you absolutely can claim the ERTC now on qualified wages, which are your payroll and health insurance expenses. It is very limited, outside wages, what else you can claim for ERTC, unlike PPP, where you could apply your PPP funding to a variety of other eligible employee benefits outside of actual wages. The issue here is that you can't use the same wages that you would have applied PPP money to, and also apply those wages to the employee retention tax credit. It's essentially would be double dipping. So the problem many organizations have in 2020 is that with the guidance, that we had with PPP and the applicability of spending 60% of your PPP loans to meet the requirements to secure loan forgiveness, 60% of your PPP had to be applied to wages, 40% to non-payroll eligible expenses. Most organizations spent the majority of their PPP on wages. Just outright, it was very easy, kept it very clean. The problem is that you basically maximize your PPP on your wages. It leaves you less flexibility on wages that are qualifying wages that remain for you to claim through the employee retention tax credit. And you can't go back and revise. Basically the way you filed your PPP allows you no flexibility in terms of going back and changing things or manipulating the numbers in 2020. You're locked in, and those wages that you paid with PPP money are no longer available for claiming for the employee retention tax credit. So I think most organizations are really focusing in on 2021, and that's this idea where you are trying to leverage your PPP, and more specifically, leverage your PPP money to max out your non-payroll eligible expenses. So trying to max out the 40%, still meeting the threshold, that absolute requirement of 60% being spent on wages to get your loan forgiveness, but making sure it's more like a 60-40 split, whereas probably in 2020 it may have been more like 100% wages and maybe a much zero or even a much lower percentage applied to non payroll eligible expenses, and again, rent, utilities, and then those were expanded obviously with the year-end 2020 legislation that added some new categories of eligible expenses that organizations could take advantage of, like business operations expenses, things like that. So now in 2021, you have a much better opportunity of really leveraging your PPP to try to free up excess wages that you can now use to claim towards the employee retention tax credit. So that's I think the main consideration. Here we are, we're finishing up second quarter. So now you have this opportunity of as you look at your PPP maybe and as most organizations may have gotten in the first quarter, maybe they got in the second quarter of this year, maybe you're still in the process of spending it down. You have this opportunity of really making sure that you free up those wages to take advantage of the employee retention tax credit. Again, making sure that you qualify with the gross receipts reduction requirements. Now we can look back. You would have known if you qualified in first quarter. If you qualified in first quarter, you get second quarter, as we talked about with the look back provision. But if you didn't qualify in first quarter, you could actually look back to fourth quarter of 2020. And if you qualified in first quarter of 2020, you automatically get first quarter of 2021. So hopefully this is starting to make sense to you. There's a lot of opportunities here. It's just that interplay of the PPP money, and you can't double dip. What you take that however you want, but you can't use the same wages that you're applying your PPP money to also claim for the employee retention tax credit. So, and I just have an example here. PPP second draw covered period starts May 1st and July 31st, and they applied it all to payroll. So if they qualified in terms of that gross revenue loss, in terms of that 20%, so they had 20% gross revenue loss in quarter one and part of quarter two, as they kind of look at qualifying, if they qualify in quarter one, quarter two, quarter three, quarter four, essentially they have all of quarter one that really is available because their PPP doesn't come into play until May 1st. So part of Q2 may still be available, and then part of Q3, because their PPP is kind of falling into 2 different quarters there. And then, of course, they're going to look at Q4, and maybe if they qualify again in Q4, they would have all that payroll available. So the main factor here is really PPP. So let's go ahead and get to these questions, and we'll see if there's anything else, Michael, that we need to come back to in terms of the credits on the state of health as well. And so, yeah, this is a great question. What's the general fee an org should charge to help a non-for-profit apply? I'm hearing $1,000 per employee. That I have no idea. I mean, I don't know what the CPA firms are charging. We Nikon has a number of CPAs on our board. We have not asked them that kind of question about a fee structure for how they are assisting nonprofits from a fee service standpoint. I have no idea, but it is an interesting question, and I have no doubt that $1,000 per employee, who knows, maybe that's the going rate. I mean, there's so many factors at play here that, it's as we were talking about, the overall credit, the potential for $7,000 a quarter for 2021 is very enticing. But if you did take advantage of the second draw PPP, that definitely will limit the amount of credit you're going to get for a couple of those quarters. So I think any fee you pay, it might pay to do some of these calculations on your own, which I think are not difficult to do. I mean, you could absolutely figure out your gross receipts reduction by making those comparisons of Q1 2019 to Q1 2021 and the other quarters, and then kind of look at where your PPP comes into play and what wages might be available. And then you can figure out, is it really worth paying that kind of fee to a third party to streamline and help you through this? Is the money worth it to the organization? And then there's a question here: to whom would we need to demonstrate our eligibility? Our payroll service did not ask for or want to see this info. Is it just that we get audited by the IRS? Yeah, I mean, I think, you're filing these, for example, in 2021, you're filing that 941 after you figure out your eligibility, and you're looking at that, the actual employee retention tax credit calculation. In terms of eligibility, yeah, that's your due diligence, that's your documentation. Is it possible that might be requested? Absolutely. But at this point, your payroll company doesn't want it. They're not going to certify, or, unless you're paying them to actually, as a CPA firm, unless you're paying them for a service. So I think, you really have to keep this documentation, just like the PPP, for those of you, who have filed for loan forgiveness with the 3508 or 3508EZ or 3508S, with depending on the form you're using, you're required to keep this documentation on file for the next 4 years, or even longer if you actually have a loan portion that you have to repay with your PPP. So you're definitely looking at holding on to this documentation. Just with your PPP, just think of it in the same way with the employee retention tax credit. And I think I don't know how long you might have to hold on to that documentation. That would be a good question that I definitely will try to see if I can get some information on. But with PPP, we have a lot more clarity of how long we have to hold on to that paperwork. Can you state the look back provision in one sentence? I'm trying to think how to answer that question. I mean, basically, what that look back provision is all about is just that once you qualify, say, for example, in Q1 2021, and you get to the end of Q2 2021, and you've gone over 80% in terms of that gross receipts reduction. and you no longer qualify, you still get that carryover into the second quarter because of the look back provision. I that's the best I can do in terms of stating that. So, so if you qualify in one quarter, you essentially get the next quarter because of the look back provision. So hopefully that makes sense. Employer paid medical premiums. Next question, employer paid medical premiums are eligible as qualified wages under ERTC. That's correct. As the employer, we pay employee insurance premiums directly to the insurance company. That money doesn't pass through our payroll services at all. Can we still claim the amounts we pay in medical insurance premiums as part of ERTC, even though the premiums wouldn't normally show up on our 941? Our payroll service did not know the answer to this. I mean, I think for most employers, they are paying their premiums directly to the health insurance company. So they aren't going to show up on the 941, I don't believe. But I'm gonna have to get back to you on this question, because I mean, my understanding is that just like the PPP, those qualified employer health insurance premiums wouldn't show up as a part of payroll. That's why there was separate documentation provided when you originally applied for the PPP. And then depending again on the threshold, the amount of your loan, whether you had to submit that full documentation or not, you'd still keep it on file. You'd keep copies of those invoices for the health insurance as documentation. So I think as a part of the tax credit, you would factor in, that health insurance premium as a part of the calculation. But I have somebody on our one of our board members who's definitely an expert on this topic as well, and let me run this question by him as well, and we can hopefully send just a quick note when we do the follow-up email, hopefully just including that answer in the email. So that's the way. We'll get back to you about that shortly. What are the rules around ERTC and FMLA sick leave tax credits? I'll just be very honest that there's more complexity in terms of you can't claim the sick leave tax credits. That gets carved out from the ERTC. So that's the easiest answer I can give you. You really, again, when it comes to some of these components, if you are taking advantage of the Families First Coronavirus Sick Leave Act, I don't know if I have the acronym or the name quite right, but some of these other opportunities, these other credits, you just like the PPP, you can't claim that and use PPP funds to pay those wages. The same concept with ERTC. You can't claim that credit, then also take those wages, use them for PPP, and use them for something like the Families First Coronavirus Act, or Credit Aid Act. So this is where it would pay to consult your qualified CPA advisor and to get a little more determination around some of this. It's not an answer I can give you right here, right now. And I will say, that we are not the expert to try to answer that question or make that determination. But I think the safe approach, depending on what resources are available to you, is to really make sure that if you're taking advantage of some of these other CARES Act credits and opportunities, especially around the sick leave, the Families First Coronavirus sick leave, that you the ERTC would not be applicable. Now, if you're just talking about sick leave in terms of what employees are getting paid because they're on sick leave and it has no tie to the CARES Act, that's pay, that's vacation pay, that's sick pay. That would be wages, and I think you'd have no issue claiming that as a part of ERTC. So hopefully that kind of gives you a direction to go in. What is an employee who's not performing services? Somebody not working. So if you're not performing services, you're not working. So, and you may be paying somebody and they actually may not be doing work. You could still claim those wages. And so so there's a question here, just I'm getting a little confused with the charts, what applies in 2020 now versus what no longer is true because of the revisions made in 2021. Currently for 2020 is the max 5,000 annually per employee or 5,000 quarterly per employee. No, it's 5,000 max. There's a very big difference between 2020 and 2021. The maximum credit you can claim in 2020 is 5,000, period. So it's 50% of the first $10,000 in wages, maximum credit, $5,000. That's it. In 2021, 70% of the first $10,000 in wages, $7,000 credit per quarter per employee, maximum credit per employee for the year, all 4 quarters will be 28,000. So again, 2020 maximum is $5,000 per employee for the entire year. So if you qualify in Q1, or that's probably unlikely, but say you qualify in Q2 and you're able to maximize that credit at 5,000, that's it. That's nothing more you'll get for the year for 2020. Can ERC and PPP cover periods overlap? Yes. Yeah, you just can't use, and there isn't a covered period for ERC. The ERC is really, it's a quarterly consideration. First quarter, second quarter, third quarter, fourth quarter. But yes, the covered period absolutely for PPP is going to overlap with those quarters. And that, you know, is a part of the calculation you're going to look at as you think about those wages. And if you're applying PPP loan to those wages, then what wages are remaining would be what you could utilize for the ERC. And then, do you recommend going through our payroll company file Form 941X for past revision or Form 941 since they usually file it, or is that something we should be able to do on our own? It probably, you know, I think would be easier to go through the payroll company. And the 941X is for 2020. The Form 941, you should be able to get your payroll company to file that, kind of present day as you finish each quarter for 2021, as you're making your determination if you qualify for the employee retention tax credit, and then what that tax credit filing would be. You'd file that kind of in process with your payroll company. So now we're wrapping up second quarter. They're getting ready to file the 941. Now would be the time to figure out what did we qualify in second quarter and how much is that tax credit. And it would be best to work through your payroll company. So I think we worked our way through those ERTC questions. Other than the employer health insurance question that we'll follow back up on. I think, Julie, was there any other questions? I think I just see, a question about grocery receipts, do grocery receipts include grant income? Yes, grocery receipts would include grant income. Yes, it would. For nonprofits, it's going to include, your donations, your essentially your revenues, any revenues that you receive outside of PPP. So that would be one factor. Depending on your accounting standards for your organization, this is where it kind of comes in, some being strategic about this. So if you have some flexibility, for example, of when you recognize grant income, you might be looking at, well, if our PPP was taking place during all of second quarter of 2021, then there's a very few wages that would be available to claim for the employee retention tax credit. So if you had a grant that you received and it might free up, say, revenue wages in Q1 and qualify the organization from a gross receipts reduction standpoint, and you could recognize that grant instead in second quarter, so it qualifies in first quarter. Now you can claim all those wages and your PPP hits second quarter. You can kind of see how this plays out from a strategic standpoint. So it from a grant income standpoint, yes, it counts for gross receipts, but do you have flexibility on when you recognize that grant income and in terms of the impact on qualifying from a gross receipts reduction standpoint? So I don't any other questions at this point? I think we have a little bit of extra time.
Do you want me to go?
Yeah, Michael, go ahead. Absolutely.
Sure. So there was a couple questions. I think I have, looks like 4. One of the questions is, what if an unemployed unemployed individual is technically eligible for insurance through their spouse, but it's not affordable, i.e. the employer doesn't pay any of the premium, and it's over $700 a month. So again, that's if it's not affordable employer-sponsored coverage for that individual, they're eligible for that nearly free or $1 plan through us. Really, how that comes about is that you're eligible if you're otherwise eligible for a subsidy, or we also call it a APTC tax credit, then you're eligible for the unemployment benefit, because really what it is it's delivered as a tax credit, and the amount is connected to the fact that you're unemployed. So you get almost the entire premium for the second lowest cost silver plan. The next one I have is, can a nonprofit employer pay the difference between the employee's subsidy and the full cost? So my take on that, the answer is no. No, not in a way that I know that you're able to do. There are other provisions such as an ICRA, an individual plan, as well as a QSERA, but those are either or benefits. So if an employer provides some sort of contribution towards individual coverage via those means, if it's considered affordable, it's an either or benefit. So the employee would have to either take what you as the employer is offering or take the subsidy from the exchange. Another one here, do some people qualify for subsidized dental and or vision insurance through the New York State of Health? Yes and no. So there is no subsidy from the federal government in regards to dental and vision. However, there are subsidized plans that include coverage for dental and vision. So for example, if you're enrolled in Medicaid or our New York State of Health Essential Plan, they include those benefits, right? If you are enrolled in individual health insurance, also known as a qualified health plan, some plans do cover dental and or vision within those plans, some pediatric, some not. So when you're shopping for the plan that you're looking to enroll in, you'd have to take a look at the specific benefits offered by each insurer to determine if you have coverage for those. And then if it's included within the health insurance portion, the health insurance is subsidized. You could also purchase a separate dental policy if you would like to, but it's not specifically subsidized itself. And then I think the last question that I see here is, do you have any programs for employers with less than 10 eligible employees? So there is a small employer tax credit that is available. It's for 2 consecutive years. It's based on a sliding scale. And if you're a nonprofit, it's up to 35% of paid premiums. When I mean sliding scale, for an employer that has 10 or less employees, but the employees earn between, I believe, 25,000 and 50,000, you'll get something. And depending on where you fall along those lines, depends on how much you would be eligible for overall. What I would suggest is going to the New York State of Health website. There's an employer tab. You can review you don't have to log into anything. You can review the requirements for the small business tax credit. We also have links out to the IRS website that goes into detail on what the tax credit is and how to go about submitting for it when you file taxes. And of course, I'm sure Andrew would be able to help. That's all that I see for me. Thank you.
Yeah, Michael, that employer tax credit, that's a great benefit for organizations that I guess for many organizations, they probably have, I would guess, many absolutely probably already claimed the credit, because it was much more a focus when the exchange first rolled out. But if an organization, like I've worked with a couple more recently that have just added employer sponsored health insurance for the first time. And so that tax credit is a great benefit, so it's very easy to do through the New York State of Health. They just have to make sure the plan gets certified by the New York State of Health, which is a really easy process. You just have to, just make sure you're using kind of a certified plan that has the seal of approval from the exchange, and then they can file that tax credit. And for nonprofits, it's a refund on your payroll taxes. I can't remember the exact percentage, but for many years, nonprofits have been able to really take advantage of that, especially those 2 years that you can maximize that tax credit. Yeah, and then I think there's one last question here that somebody was asking that goes back to the employee retention tax credit. And they were just asking, do grocery receipts included in grants from an organization that we are fiscal sponsors for, do they count? Because they don't use that, do not use that funding. And that obviously is a very unique circumstance. And I guess the unfortunate answer to that question is yes, those grocery receipts from those grants do count as grocery receipts for your organization, because you're acting as a fiscal sponsor. So any of those funds that are coming into your organization on behalf of that fiscal sponsor are treated as income revenue. They would be treated as gross receipts for your organization. So that's unfortunately, I guess, one of the drawbacks when it comes to those unique circumstances where nonprofits sometimes are acting as fiscal sponsors for other nonprofits. So that will be a factor, I think, as you look at your gross receipts reduction calculations, and depending on when those grants for that other organization kind of hit, when you're recognizing them, in terms of your quarter and the quarter comparison, and looking at what that impact has. So, but I think that's the last question. So, Julie, Michael, anything else you want to add at this point?
No, other than just saying thank you for the invitation, and I hope everyone found it useful.
Great. Well, thank you, Andrew. Thank you, Michael. We're greatly appreciative. We'll send out slides and recording and contact information if you want to follow up with additional questions. And we will be in touch with everyone soon with all of the resources. Thanks, everyone.
Thank you.